All right, let's take a look at markets right here. The Dow Jones Industrial Average expected to be down a bit this morning, down about 30 points, another triple-digit move yesterday. Markets are mixed after the Senate Finance Committee advanced its tax reform bill last night, hours after House Republicans passed their own bill to overhaul the nation's tax code. I want to bring in the CEO of Principal Global Investors. Jim McCaughan is here. Good to see you, Jim. Thank you so much.
Good to be with you, Maria.
For joining us. Jim McCaughan. My apologies, Jim. $445 billion in assets under management. You've got to allocate that. What are you doing right now, given where these markets have come from?
Well, I think U.S. equities are still a buy-the-dips market. I say that with a lot less, with a lot more nervousness than I did 2 or 3 years ago, because they are at a higher level. But if I look at where we've got to in terms of ratings, 20 times earnings, 5% earnings yield against a 10-year bond yield of 230, that sounds like really pretty good value. So I would continue to buy the dips. And there is the added dimension that if a meaningful and coherent tax reform can pass through to the president's desk, then that would be a further boost to the market, in my view.
Where do you want to be exposed? Do you want to be in those small caps where you would imagine are beneficiaries of this plan,
yeah,
or the large caps, or sectors?
I like small and mid caps, and don't forget the mid caps. The small and mid caps tend to be domestic earnings, and I would say that in terms of growth in the economy and profitability, the U.S. is probably the best placed developed economy. So if you're in that domestic economy, small and mid caps are a nice place to be.
You said if a meaningful and coherent tax plan reaches the president's desk.
Big words.
I got those words.
Yes.
And so I'd like to ask you a little bit about that. Are you talking about, is that a bigger issue on the small business tax side, on the corporate side, or is it on the individual side where you see there's maybe a chance for not so much coherence?
Yeah, there's not really much happening on the individual side. Really, the priority in Congress is clearly to do something about corporate and pass-through business taxation. And if they can reduce the marginal tax rates, that will, in economic terms, make a very big difference to the incentive structure in the economy. After all, the famous tax returns in history, Reagan and Thatcher in the 80s, what they depended on was reducing the marginal rate of tax while broadening the tax base so that there isn't a destabilizing deficit. And if they can do that, that's what I mean by a coherent tax reform.
So you're looking for more on the individual side, actually?
In due course, yes. Okay. But I think they've got to start somewhere. And clearly the priority, which at least started off as a bipartisan priority, is to do something about the incoherence of our corporate tax structure. I mean, that is clearly more incoherent even than our individual taxes.
So you think more will come then on the individual side?
Oh, I think it could. I think it could. I think this is not necessarily one and done.
Right,
and they're trying to do it very quickly, which is the thing that bothers me. Getting it done by December the 12th sounds very ambitious, because this is darned complicated when you really get to it. And one of my fears is that it will have unintended consequences.
Okay, within a month, we've got the Fed potentially raising rates, and then you see a bunch of governors talking about even 3 hikes next year. How do you think that plays out in the market, and what are your forecasts for next year?
I think the market will be just fine with a 25 basis point raise in December. I think it's almost 100% consensus now.
Yeah.
Be a surprise if they didn't. It wouldn't necessarily be good news if they didn't, because it would suggest they think there's some softness in the economy. For next year, I'm a bit below the Fed dot plot. I would say 2 rate increases next year rather than 3, rather. But, if it's 1 in December, 2 next year, that takes the Fed funds rate to about 2%. That doesn't mean the 10-year yield's going up. You could accommodate that in a yield curve flattening. And that's really my central expectation. And that leads me to think it's probably a pretty decent year for equities.
Jim, just real quick, what are the unintended consequences you're talking about?
I was just going to say that.
Well, if you take away, broadening the tax base will take away some deductions. That's how it works. Some of those deductions being taken away may have job consequences. I've heard 1 or 2 in the last few days where there is concern that if you tax, for example, access to foreign capital, then you may well cause some issues with jobs. So I'm concerned that the unintended consequences are avoided. And that's what usually happens when they take time over a tax bill. It's not just bureaucracy, it's really to work those things through. I'm optimistic they won't be too bad, but I think there is that risk.
You still like technology here?
I do, actually. I mean,
the FANG stocks have been just off the charts.
And as you say, some of them are probably too high. But if you take the whole basket of technology, that's actually one of the reasons why the US private sector is so strong and so important, is utilization of technology. Compare our market with foreign markets. I mean, there's just no comparison. We have technology, the economy of the future. If you look at Europe, the big companies are oil companies and banks, you know, fine companies, but they're not the economy of the future. That's what makes me very attached to the US equity market in particular.
That's a very good point.
Technology is growth at a reasonable price, especially when you can compare it to consumer staples.
Yeah, no, that's right.
Jim, it's great to have you on the show today.
Great to be here.
Please
Thank
come
you, Maria.
back soon.
Will do.
Thanks so much. Jim McCaughan joining us there.